This week, inflation was the main thing we had our eye on. And unfortunately, both the Consumer Price Index, CPI, which is the inflation that you feel at the store and at the pump, as well as Producer Price Index, that's PPI, wholesale inflation, they both came in hotter than expected, and this had some people and investors thinking inflation might not, necessarily be an issue of the past just yet. And the PPI did show a slight month-over-month increase, but that doesn't directly bleed into the inflation you feel. But some of these numbers do feed into the Fed's favorite measure of inflation, which is PCE. And meanwhile, the CPI, again, which captures changes in consumer prices, that was up primarily because of housing costs again, but we are finally starting to see shelter numbers come down a bit. Despite those inflation numbers, Fed's still focused on labor market numbers, and a number of Fed members have said that they are not too concerned about inflation at this point. The markets, though, are not betting as aggressively on cuts by the end of the year, and mortgage rates have been hurt a bit as a result of these shifts, which is a bummer because we've had a pretty good rally for a minute there. The Fed's focus on labor market numbers basically means unless we see weaker numbers, especially in the next jobs report on November 1st, rate relief might take a little while. But next week we're going to get retail sales and housing data, and both could influence the market, and I'll be sharing that news next Friday. But while we have seen rates jump a bit, they are still more favorable than they were a year ago, which is something for buyers to consider as they think about home ownership. And another bright note, foreclosure starts as well as bank repos are down, showing more strength in housing despite these higher borrowing costs. But have a great weekend, and I'll talk to you next week.